Hey everyone, welcome back to Ask an Actuary, where we ask our team of actuaries your top questions. I'm Stephanie Irvin, and today I'm sitting down with Andrew Taggart, a consulting actuary here at Odyssey Advisors, to talk about the ideal candidates for cash balance plans. These retirement plans can definitely be a game changer, but they're not for everyone. So stick around because we're going to break it all down. Can you talk about what factors make for the ideal candidate for cash balance plans?
Right. So there are a few factors that make adding a cash balance plan to your portfolio advantageous. First of all, you'll need to save a large amount of money for it to make sense each year. And second, you will want to have a stable enough income to be able to make this commitment annually for at least 5 years. Third, you want to have the right number and types of employees in your company.
When you say that you'll need to save a large amount of money each year, what exactly do you mean?
Right. So a cash balance plan is intended to be layered on top of a 401k and a profit sharing plan. So the contribution limit for those plans combined in 2024 was $69,000 with an additional 7,500 of catch-up deferrals for people over 50. So that totals a little over $75,000. So you'll want to be able to consider adding a cash balance plan. You'll want to save well over $100,000 combined with those other plans.
And when you talk about a stable enough income, do you want to break that down?
Right. So with a 401k plan and a profit sharing plan, you can adjust how much you save each year. And it's not really required. You could save nothing if you have a really bad year. But for a cash balance plan, the contributions are locked in and required by the IRS to be made each year. Now, we can do some things when we design the plan to make it based off of your pay and stuff like that so that we can adjust how much you're contributing as long as we know ahead of time and you set it up the right way. We can adjust how much you need to contribute each year if you do have a little bit of an off year. But for it to make sense, you still want to be making sizable contributions to the plan each year.
And looking back to something you mentioned earlier, you talked about that you need to have the right number and type of employees in your company to be an ideal candidate for the plan. Can you break down what you mean by that?
Right. So the way a cash balance plan works, for it to work, you need to pass what's called non-discrimination testing. These tests are designed by the IRS, and they ensure that you're not favoring highly compensated employees, people making over, I think it's 135 or $140,000 a year as of 2024, more than the non-highly compensated employees. Now, obviously, with these plans, we are trying to get the owners or highly compensated employees a lot of the money. So, to pass these tests with our actuarial math, the only economically viable way is we're looking for older, highly compensated employees and younger, non highly compensated employees. And also, to make sense, since there is a minimum amount you're going to have to give to every employee, um, a lower amount of non highly compensated employees is, and usually below 20 or more like below 10 or something like that makes the most sense, usually.
Thanks for breaking that down for us, Andrew. I think that's it for today. So for our viewers, hopefully you now have a better understanding of what it takes to be an ideal candidate for cash balance plans. As we mentioned before, it's not ideal for everyone, but if you fit into what Andrew talked about, it definitely is a game changer. If you have any more questions or need personalized advice, feel free to reach out to us. Don't forget to like this video, and you can follow us here on LinkedIn, YouTube, or Facebook, and that way you can never miss an episode. Thanks for watching, and we'll see you next time.